Today, I want to talk to you about the basics of dividend investing, specifically how dividend investing can help you in your retirement, both build wealth and have reliable and growing income throughout your retirement, and also sleep pretty well at night.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
Most people know that a stock represents a part ownership in an underlying business. However, that's not the way most people actually think about stocks. Most people think about stocks in terms of their price. This is a chart showing the actual Texas Instruments stock price from 1983 to 2021. Most investors get caught up in the psychological roller coaster that is stock prices. Investors in Texas Instruments were very, very happy as long as the stock price went up, which it did for many years from 1991 all through 1998. The problem with Texas Instruments and many other stocks is that they do not always go up. There are inevitably times when the stock price goes down. Sometimes this is just a little bit, like from 1999 to 2000, but sometimes it's a lot. From 2000 to 2002, Texas Instruments stock dropped by over 50%. It happened again in 2008. The problem most investors have is that they don't understand why Texas Instruments or any other stock still has value. So when the price inevitably falls, they get scared and sell their stock, usually at the bottom. But what if I told you that there is a key driver to Texas Instruments and a lot of different stocks out there, and that is the dividend. Understanding the power of the rising dividend will change the way you view stocks forever. This is the exact same chart of Texas Instruments. We have price indicated here on the right axis and the blue line. That's the price of Texas Instruments stock. These orange lines represent dividend payments. Texas Instruments first started paying dividends back in 1998. They paid a dividend of 9 cents per share for the entire year. That dividend remained constant until 2004. In 2004, Texas Instruments Board of Directors did something that probably seemed pretty small to investors at the time. They raised their dividend from 9 cents to 10 cents. This increase from 9 cents to 10 cents a share would begin a streak of nearly 20 consecutive dividend increases. You can see that every year since 2004, this orange bar representing the dividends has increased every single year. Now, why is this rising dividend so important? Well, for two reasons. The first reason is that dividends and stock prices are different. So in 2008, when the stock price of Texas Instruments fell from $33 per share at the end of 2007, all the way down to $16 per share at the end of 2008, the dividend actually went up by approximately 10%. So even when the stock price was falling by 50%, the dividend income was increasing by 10%. So let's say your entire investment portfolio was made up of Texas Instruments stock. We would not advise that. Of course, you need to diversify away from just one stock. But hypothetically, let's just say that you were living on the income being generated by Texas Instruments dividends. If you had just held on to your shares and just spent exactly what the dividend income that was being produced, you would have actually gotten a 10% raise in your actual income, even when the stock prices were going down by 50%. We'll talk more about that in just a second, but now I want to illustrate the second important point of the power of the rising dividend, and that is its impact on the stock's price. Let's take a look at this chart again. Is there anything you notice about the movement of the blue line and the movement of these orange bars? Clearly, they tend to go in the same direction. The blue line, which represents the price of the stock, does sometimes move against the orange line. For example, in 2018, the dividend went up quite a bit while the stock price went down. However, over time, there is a clear relationship between these two. For example, in 2008, the dividend for Texas Instruments was 44 cents a share. In 2022, the dividend was $4.60 a share. If I get out my trusty Texas Instruments financial calculator, we can calculate what growth rate the dividend experienced from 2008 to 2022, the start of 2022. Over this period, the dividend grew by 19.8% per year. Now the question is, what about price? In 2008, the stock price for Texas Instruments was $16 a share. At the very beginning of 2022, the stock price was $188 a share. If we pull out the financial calculator and calculate what the annual growth rate of the price was over this time, it is 20.9% per year. Does that seem like a coincidence to you? It doesn't seem like one to me. The point is that as a company grows its dividend, the stock price should and eventually will move with it. Of course, the trick is knowing which companies are going to be able to increase their dividends in the future and understanding approximately what that dividend growth rate is going to be. But the point is that over time, if you identify companies that grow dividends and can keep growing them over time, your stock prices will eventually follow the fundamental value of that business. Let's assume that Texas Instruments is able to grow their dividend at 8.3% per year from 2022 through 2032, so the next decade. Since they began increasing the dividend back in 2004, they've never increased the dividend by less than 8.3%, so we'll assume that this is a relatively conservative estimate going forward. Of course, future results may vary, but just for illustration purposes, let's assume they can keep growing it at a constant rate of 8.3%. The green bars are our forecasted dividend amount. So if they can maintain this pace in 2032, the dividend per share would increase from $4.60 in 2022 all the way to $11.10 in 2032. Now, what we don't know is what is going to happen to the stock's price over this time. But let's just say, hypothetically, the stock price went absolutely nowhere. It just went flat all the way to 2032. And remember, the stock price is currently $188 per share. So let's fast forward here to 2032. Texas Instruments is now paying $11.10 per share in dividends. The stock price at this time is still $188 per share. So if we take the dividends being paid each and every year and divide that by the stock price of $188 per share, investors would be able to get a dividend yield of 5.9% per year. So even with the stock price not growing at all, these investors would make about 6% annually on their investment. Plus, this dividend is growing over time, so this 6% will continue to increase as Texas Instruments increases their dividend. What do you think investors are going to do when they see a 5.9% dividend yield in a growing business like Texas Instruments? Do you think they're going to buy it or sell it? Unless something horrible is going to happen with Texas Instruments in the future, the probability is that the stock price is going to increase over time to match the dividend, just like we saw in the past. How much is it likely to increase? Well, we can take a look back and see what the historical relationship between the dividend and the price has been. That yield has averaged around 2.5% in Texas Instruments history. But let's use a more conservative number. Let's use a higher dividend yield, which suggests that the stock price is a little bit depressed in relation to the dividend being paid. The highest dividend yield Texas Instruments had was back in 2018. In that year, you can see that the dividend was a little bit higher than the price. The price was down while the dividend went up. The dividend yield at this time was 3.26% per year. That was the highest it's been at the end of each year going back this whole time. So let's say conservatively, we're going to have the same dividend yield here in 2032. So if the dividend was $11.10, we can simply divide that by our estimated dividend yield of 3.26%. And if we do that, we get an estimated stock price of $340 per share. So not only was the dividend income being paid by Texas Instruments increasing over time, but that dragged the stock price up as well. So if you're an investor in Texas Instruments, you're making money both on the dividend being paid today, the increase in that dividend over time, and the increase in the stock price over time. So what does this mean for a retiree? Let's say hypothetically you would retire at probably the worst possible time, which was December 31st, 2007. That was right before the great financial crisis, which saw the S&P 500 and many stocks, including Texas Instruments, drop by over 50%. So let's say you dumped $1 million into a portfolio entirely consisting of Texas Instruments. Again, you would never do this. You would diversify across other dividend growth stocks, but we'll just say, for illustration, you chose Texas Instruments. You invested $1 million on 12/31 of 2007. So here is your starting portfolio value represented by the blue line. The orange bars, again, represent the amount of dividend income you would have received. At the time, the stock price was $33, which means your $1 million would have bought you 29,940 shares. So in 2008, Texas Instruments' stock price completely collapsed all the way down to $16 a share, which means that your investment that was worth $1 million just a year before is now down to $464,671. If the only reason you own Texas Instruments was to see the stock price go up, you would be feeling pretty sad indeed. However, you are not buying it just for the stock price. You are buying Texas Instruments for the income it's generating for you. And in 2008, each of your 29,940 shares would have paid you 40 cents per share in dividends. So if you multiply 29,940 by the dividend, your income in 2008 would have been 11,976. And let's say that you did not reinvest into the stock, you simply spent every dime that Texas Instruments generated for you. So you kept the same exact number of shares all of these years, but what happens is as the dividend per share starts to increase, so does the income that you receive. So in 2009, the dividend went from 40 cents to 44 cents. So your income would have increased by 10%. That happened again in 2010, again in 2011, and over the next decade, the income being generated from your portfolio went from $12,000 roughly back in 2008 to $122,000 in 2021. And if we assume that Texas Instruments is able to grow their dividend by 8.3% like we did in the last chart, that means your dividend income over the next 10 years will go from $122,000 all the way up to $306,000. And this is all happening without you adding any additional money to your portfolio. This is only what the business is generating on your behalf and increasing over time. But remember, that's not all. You still own the shares, and those shares still have a market value. So while your income continues to increase, most likely so will the market value of the portfolio. If we go back here to 2008, you started with $1 million. That dropped significantly to under $500,000. But if we just skip ahead to 2021, let's assume you just kept your shares the whole time. The market value of Texas Instruments was $188 per share, which means your 29,940 shares would have been worth over $5.6 million. And if we fast forward to 2032, again, assuming you still own the same 29,940 shares, and assuming the dividend yield is the highest it's been, the estimated value of the portfolio would be over $9.4 million. And remember, that's even with you spending all of this money each and every year. You never reinvested any of these dividends back into the business. So this is the power of the rising dividend. If you can build a well-diversified portfolio of high-quality businesses that have a ton of free cash flow and can afford to both pay a dividend today and increase that dividend over time, you're going to do several things for your portfolio. Number one, you're going to have consistent income that you can spend today. Number two, that income is going to grow for you each and every year throughout your retirement, likely keeping up with inflation and even increasing above and beyond that. And number three, you're likely to increase the market value of your portfolio over time. And number four, you're going to give yourself a reason to continue owning your stocks even when the market value is declining. We saw back in 2007, 2008 with Texas Instruments, the stock price dropped 50%. That is likely going to happen at some point over your investment lifetime. There are going to be times when the market goes down by 10, 20, 30, 40, even 50%. But if you have a well-diversified portfolio of dividend growth stocks, you can continue to receive your dividend income. You continue to spend that on your lifestyle. You're not going to need to sell any shares at bad prices just to fund your expenses. You're going to sleep a lot better at night knowing that you own some of the world's best companies, and those companies are paying you a cash dividend each and every quarter. So regardless of what happens to stock prices, you know that your retirement income is still going to be there. Just keep in mind that when you're building a portfolio of dividend stocks, it's important to consider more than just the dividend yield. You want to look at dividend growth rates. You want to look at payout ratio. So how much is the business paying relative to what they're actually bringing in? There are some cases when a business will issue equity or issue new debt to cover its dividend. And to buy into a company like that means you may be getting a dividend for now and even for the next couple of years. But over time, that growth will either go away or the dividend could be cut. So you must pay attention to the kinds of businesses you're owning. Make sure you do some in-depth fundamental analysis into those. Make sure you understand the balance sheet, the ability for them to pay a dividend going forward. But if you can do it successfully, the dividend growth strategy can be one of the most powerful ways to generate income in retirement and build wealth consistently over time. If you're interested in seeing the types of businesses that can likely continue growing dividends over time, check out this next video. Thanks for watching, and I will see you in the next one.